On March 31, 2026, Berkshire Hathaway filed a routine quarterly report with the Securities and Exchange Commission. Buried inside was a single number that has stopped Wall Street cold: $397.383 billion in cash and short-term treasury bills. That number is larger than the GDP of Norway. It sits on the balance sheet of one company, untouched, earning risk-free interest while the S&P 500 grinds to fresh all-time highs. For 60 years, Warren Buffett built the most successful investment record in modern history by doing one thing better than anyone alive.
For most people, in terms of that decision, is their spouse. It's also important in terms of a partner in business, but the partner in life is
deploying capital, compounding wealth at 19.9% per year. So, when the most patient investor on earth refuses to buy stocks and parks nearly $400 billion in government debt, the question is, what does he see that the market refuses to acknowledge? Start with the most important fact. Berkshire now holds more cash than stocks: $397.4 billion in cash and treasuries, $288 billion in public equities. The cash pile exceeds the stock portfolio by more than $109 billion. It is called an inversion. It has never happened at this scale in Berkshire's history. Cash now represents nearly 32% of total assets, the highest in at least 3 decades. Of that hoard, $339.2 billion is parked in short-term treasury bills, maturities of 3 months or less, liquid, safe, earning roughly 5%. At a conservative 5% yield, that stockpile generates roughly $17 billion a year in risk-free interest. Berkshire is being paid to wait, and that interest income is not idle. For the first time in modern Berkshire history, holding cash is more profitable than buying most of the stocks Buffett used to love. How did Berkshire build this fortress? Not by accident. It is the consequence of a deliberate 4-year campaign of selling, 14 consecutive quarters. That is how long Berkshire has been a net seller of public equities. From the fourth quarter of 2022 through the first quarter of 2026, $194.8 billion more sold than purchased. One quarter dwarfs the rest. The second quarter of 2024, $75.5 billion in net sales, the largest single quarter of equity liquidation in Berkshire's history. That quarter has a name: the Apple exit. In 2016, Buffett began buying Apple. By 2023, his stake had grown to 915 million shares, the single largest position in the portfolio, more than 40% of invested equity assets. Buffett called Apple the best business he had ever owned. Then, in early 2024, he started selling. He did not stop. First quarter of 24, 116 million shares gone. Second quarter, 389 million, nearly half the position liquidated in 3 months. Third quarter, another 100 million. By the first quarter of 26, the position was down to 228 million shares, a 75% reduction. 3 out of every 4 Apple shares Buffett owned at the peak sold. Cost basis on Apple: roughly $9 billion. The gain approached 600%. In 24 alone, Berkshire booked $101 billion in taxable investment gains, almost entirely driven by Apple. At the 24 annual meeting, Buffett pointed to taxes and federal deficits. He said it would not bother him to write the check, but that was only half the story. In April of 2026, retired and reflective, Buffett sat down with CNBC and said something different. Berkshire sold Apple too early. The stock kept climbing. He admitted the timing missed. Then he hit the brakes. He said it is not yet time to buy the dip. He has lived through 3 market crashes of 50% or more. Current pullbacks, in his words, are statistically insignificant against historic overvaluation. That is the tell. He sold too early, but he is still not buying. Apple was not the only victim. Bank of America. Between mid-24 and the end of 25, Berkshire dumped 515 million shares, roughly half the peak stake. Citigroup, 40.6 million shares sold in the fourth quarter of 24. The remaining stake fully liquidated in the first quarter of 25. Snowflake, the cloud data company Berkshire bought into during its IPO, fully exited. Paramount Global. Buffett took the microphone at the 24 annual meeting and called it his decision, his mistake. His words: smarter now, but also poorer. HP pared down. Across the portfolio, the pattern is the same: trim, exit, raise cash. On December 31, 2025, Buffett officially stepped down as CEO. 60 years, 6 million % in book value growth, 20% annualized returns, numbers that will likely never be matched in finance again. On January 1, 2026, Greg Abel took the chair. Anyone hoping Abel would unleash the cash pile was disappointed. Within weeks, Abel published his first annual letter, 18 pages. Buffett's folksy metaphors replaced with rigid operational frameworks. His message was unmistakable. He wrote, quote, "My role is to ensure our liquidity levels and capital deployment remain intentional and deliberate," end quote. He confirmed no plans for dividends. He would not rush to deploy the dry powder. Then Abel did something Buffett rarely did in writing. He drew a line. He pledged to avoid businesses that, in his words, undermine the fabric of society or jeopardize Berkshire's reputation. Wall Street decoded that line in real time. CFRA research read it as a deliberate negative screen against speculative AI companies and ethically ambiguous platforms. The new CEO was telling shareholders he would not chase the AI bubble. One more change at the top. Weeks before Buffett stepped down, Todd Combs, one of Berkshire's two long-serving investment lieutenants, left for JPMorgan Chase to head a $10 billion investment unit. His departure left Ted Weschler and Greg Abel as the sole architects of the entire $288 billion equity book. While Berkshire sold America, it bought Japan. Since 2020, Buffett has been quietly building stakes in the 5 largest Japanese trading houses: Itochu, Marubeni, Mitsubishi, Mitsui, Sumitomo. By the end of 25, scaled to roughly 10% ownership across the board. Cost basis, about $15 billion. Current market value by early 26, nearly $44 billion. In March of 26, Greg Abel made his first major capital deployment as CEO, $1.8 billion into Tokio Marine Holdings, Japan's oldest property and casualty insurer, combined with a 10-year reinsurance agreement to assume part of Tokio Marine's net liabilities. But here is what makes the Japan trade extraordinary. It is not just the assets, it is the financing. Berkshire is not buying these stocks with dollars. It funds them with yen-denominated bonds, borrowing in Japan at Japanese rates to buy Japanese assets. In 25 alone, Berkshire issued the yen equivalent of $3 billion in senior notes at coupons between 1.35 and 3.12%. It then deploys that borrowed yen into trading houses, paying total shareholder returns of 4 to 7.8%. The spread is locked, currency risk eliminated. Dividends arrive in yen, paying down the yen debt automatically. This is not a stock pick. It is financial engineering at the institutional level, and it tells you what Buffett and Abel think of American stock prices. If domestic equities offered comparable risk-adjusted returns, none of this would be necessary. So where does the U.S. market actually stand in 26? The numbers are alarming. Start with Buffett's preferred metric, the Buffett indicator, total U.S. stock market capitalization divided by GDP. Buffett called it, quote, "probably the best single measure of where valuations stand at any given moment," end quote. He said 200% meant you were playing with fire. As of May 26, the Buffett indicator stands at 226.8%, 2.4 standard deviations above trend, higher than the dot-com peak of 2000, higher than the post-pandemic frenzy of 2021, the highest reading in modern financial history. Next, the Shiller cyclically adjusted price-to-earnings ratio, 40.1. The S&P 500 has not crossed a monthly cape of 40 since September 2000, the exact zenith of the dot-com crash. Within 24 months of that reading, the Nasdaq fell 78%, forward price to earnings, 20.6, against a long-run median closer to 16. The equity risk premium, the extra yield investors demand for owning stocks instead of bonds, has compressed to almost nothing. Market concentration, the 7 largest tech companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, now represent more than 30% of the entire S&P 500. Broad index performance depends on a handful of megacaps executing flawlessly on AI revenue. This is the same fragile breadth structure that defined the Nifty 50 era of the 1970s. It did not end well. Now overlay this against Buffett's 60-year track record at market extremes, 1969. At the height of the go-go market, Buffett dissolved his entire investment partnership and returned the capital. He told investors he was, quote, out of step with present conditions, end quote. Within 5 years, the 73 to 74 bear market wiped out his peers. Buffett was already in cash. 1999. At the Sun Valley Conference, surrounded by tech billionaires, Buffett warned valuations were detached from future profits. Barron's put him on the cover and asked, "What's wrong, Warren?" Within 24 months, the Nasdaq dropped 78%, 2007. Berkshire was again building cash to record highs. When the crisis hit, Buffett deployed $5 billion into Goldman Sachs at a 10% dividend yield. then $5 billion into Bank of America in 2011 at 6% plus warrants. He bought the panic, but only after it arrived. The pattern is undeniable. Buffett raises cash years before crashes. He sacrifices upside at the end of bull markets for the firepower to dictate terms when panic arrives. That is what the $400 billion cash pile is: weaponized liquidity, waiting. And Buffett is not alone. Howard Marks of Oaktree recently described it in 8 words. Quote, "This is not a market that's on sale." End quote. He has shifted client portfolios into defense first. Ray Dalio of Bridgewater has stated explicitly that markets are in bubble territory. He warned of an AI-fueled stock bubble and the risk of an economic heart attack. Stanley Druckenmiller, who averaged 30% annual returns for 30 years without a losing year, sold Meta entirely in late 25 and pivoted into international value plays. Brazil, Goldman Sachs, he is preparing for a weaker dollar. And Seth Klarman, who once held 50% of his fund in cash through the housing crisis, has resumed adding to defensive cash flow generators while trimming Alphabet. 5 legendary investors, 5 different strategies, 1 identical conclusion: $397.4 billion in cash and treasuries, 14 consecutive quarters of net selling, Apple cut by 75%, Bank of America cut in half, a new CEO who refuses to chase AI, a Buffett indicator at a record 226%, a CAPE ratio at 40, last seen at the dot-com peak. None of this is hidden. None of it is theoretical. Every figure is pulled directly from Berkshire Hathaway's own SEC filings and from Buffett and Abel's own public statements. The most successful investor of the modern era spent the final years of his career systematically liquidating American equities and parking the proceeds in government debt. His successor's first act was to confirm the strategy and pledge to remain, quote, "intentional and deliberate," end quote. Markets can stay irrational. Bubbles can extend further than anyone expects. Buffett himself admitted he sold Apple too early. In 1999, the press laughed at him. 2 years later, they were not laughing. The question is not whether Buffett is right about the timing. It is whether you understand the signal he is sending, because the man who built the greatest investment record in history is, for the first time, choosing the safest asset on earth over almost everything else. And his last act as CEO was to make certain his successor would do the same.